welcome. Today we are really getting into it, looking at the recent volatility we've seen across the big crypto markets. We got a ton of fantastic source material from you covering everything from Bitcoin's pretty incredible recovery to some surprising moves in the altcoin space.
Yeah, there's a lot to unpack.
And our mission here is really to go beyond just the daily ticker price. We want to understand what these numbers are telling us about the market's, its fundamental structure. Is this system healthy? Can it actually take a punch?
That's absolutely the right question to be asking because, short-term price moves can often just be noise. It's so easy to see a sharp drop and just focus on the loss.
Of course.
But what the sources are really showing us is a market that's kind of fortifying itself. So yes, some assets are trading lower than where they started the year, but the way this volatility is playing out, the fast recoveries, the flushing out of all that speculation, it actually points to a healthier foundation for what comes next.
Okay, so let's start there with that structural health. And you have to begin with the big one, the barometer for everything else, Bitcoin. The sources seem to be saying that even with this turbulence, the recent action shows a really an amazing ability to bounce back immediately.
It really does. I mean, the raw data tells a story of resilience. Let's look at the numbers you sent over. BTC's opening price for the year was $93,455.
Right. And it is trading below that now.
It is. But let's zoom in on that recent stress test. We saw Bitcoin pull back to a multi-month low, $80,620. That was just back on November 21st.
And a low like that can really shake people's confidence, especially if they're new to the space.
Oh, absolutely. But here's the crucial part, the response. It was almost immediate. BTC shot back up to $87,551.
Wow, so that's an 8.6% jump in just 4 days.
In 4 days. That's not what a collapsing market does. That kind of rapid snapback shows you there is powerful support buyers stepping in the moment the price hits those levels. It tells you the long-term holders are defending that price.
And we should probably put that year-to-date decline, which is about 6.3% from the open, into the right context.
Yes.
Because before this recent drop, Bitcoin was actually profitable for most of the year. It was only really below that $93,000 mark for a short time in the spring.
Exactly. For the vast majority of 2024, it was in the green. And we can't forget the upside we've already seen this year.
The all-time high.
The all-time high. The sources remind us that BTC hit a 30% year-to-date gain when it peaked at $126,220 back in October.
So we're talking about a temporary dip in a year that's already proven there's huge upside potential.
Precisely. The volatility is a two-way street, and in Bitcoin's case, that downside volatility is being met with immediate strong demand.
Okay, so Bitcoin is kind of the standard for resilience right now. Let's shift to the rest of the market, the altcoin landscape, because this is where it gets really diverse. And that divergence itself is a sign of a maturing market, isn't it?
It is. The days when the entire market just moved as one big block are fading. When you look away from BTC, the performances, well, it's all over the place. And that's where you really see the higher risk-reward nature of altcoins play out.
Greater potential swings, up and down.
Exactly. And some of the negative swings for the big names have been pretty dramatic.
Let's hear them.
Well, Ethereum, for instance, is down quite a bit more than Bitcoin. We're talking a decline of between, say, 12 and 16% year to date.
Okay, so that's a noticeable difference.
A huge difference. And as you go down in market cap, the drops get even steeper. Solana, for example, has had a major drawdown. It's down 27.8% from its yearly open.
Wow.
And it gets worse. Cardano is down 50.7%. And Dogecoin is down a whopping 52.6% year to date.
So those are serious declines. That really shows the flight to safety, or at least away from the more speculative assets.
It does. But, and this is the fascinating part, the market isn't just one big sea of red. It's differentiating. You have these huge drops right alongside some major exceptions, coins that have actually seen substantial growth this year.
Which is such a critical point. It shows that investors are being selective.
They're being very selective. For example, BNB is up 21.5% year to date. Tron is showing solid growth, up 7%, and XRP has also posted a healthy gain of 6.8% since January 1st.
So these assets are pushing ahead despite the broader pressure. That suggests their growth is coming from something else, something specific to their own projects.
Exactly. It's being driven by things like utility or ecosystem growth, not just, the general market tide lifting all boats.
This is a perfect transition to what I think is the most insightful part of the sources.
Yeah.
We have to look under the hood a bit at what analysts are calling a positive cleaning mechanism.
Yeah.
This counterintuitive idea that these sharp price drops are actually good for the market's health.
This is where the mechanics get really interesting. We're talking about something called open interest, or OI.
Okay, so for anyone who doesn't follow the futures market, what is open interest?
It's essentially the total number of outstanding futures contracts that haven't been settled. You can think of it as a proxy for how much leverage or, borrowed money is in the system at any given time.
And what happened to that OI metric during all this volatility?
It saw a massive, and I would say very necessary, unwind. The sources show that Bitcoin futures open interest has fallen off a cliff since that big market move back in October.
How big of a drop are we talking about?
It's significant. One measure puts the drop at 15%, from about $68 billion down to $58 billion. But another data source, CoinGlass, which is often more comprehensive, it suggests a much steeper fall.
Okay.
A 32.9% drop, that wiped out nearly $30 billion, $29.71 billion to be exact, in open interest.
$30 billion of leverage just gone. I mean, that sounds catastrophic. Why on earth are analysts framing that as a bullish sign?
Right. It seems backwards. But that's the absolute key to understanding the difference between a volatile moment and a real crash. When you have that much leverage, especially all betting on higher prices, it makes the market incredibly brittle.
Like a rubber band stretched too tight.
Perfect analogy. When volatility hits, those leveraged positions get liquidated automatically. They get forced sold. And that creates a cascade.
Liquidation cascade.
Exactly. One forced sale pushes the price down a little, which triggers the next liquidation and the next, and so on. It artificially hammers the price down way more than it should. So by wiping out that $30 billion in leverage, well, the rubber band is just relaxed.
So the price drop we saw was less about a fundamental change in Bitcoin's value and more about this forced removal of super risky bets.
That's it in a nutshell. Analysts see this huge drop in open interest happening at the same time as falling prices, and they see it as a massive de-risking event. The speculative froth is gone. And historically, this kind of cleanup sets a much, much healthier foundation for the next move up.
The next rally will be built on actual capital, not just risky margin trading.
Precisely. The system has proven it can take its medicine and stabilize itself. If the market were truly weak, the price never would have recovered that 8.6% so quickly after all that leverage was wiped out. That's the real signal of resilience.
That is fascinating. So while all this mechanical stabilization is happening, there are also these major fundamental developments moving forward, the stuff that provides real long-term value.
Yes, and that's the other side of the coin. The building doesn't stop just because prices are down. The integration into mainstream finance is actually speeding up.
Okay.
Look at XRP.
What's the latest there?
Well, the sources highlighted that the International Monetary Fund, the IMF, has actually cited XRP as one of 3 possible solutions for a global cross-border settlement.
The IMF. That's a massive deal. What does that mean in practical terms?
It means they're acknowledging its potential to solve a huge, expensive problem. Moving money across borders now is slow, costly. It relies on this ancient correspondent banking system. The IMF, pointing to XRP, is basically validating its ability to provide instant, cheap settlement. It's validation at the highest possible level.
And there was something else related to that for both XRP and Cardano.
That's right. Both were spotlighted by CoinMarketCap because they've been placed in the ISO 2022 token category. Now, this sounds technical, but it is vitally important for institutional adoption.
Okay, break that down for us. ISO 2022. Why does it matter?
Think of it as the new global language for financial messages.
Yeah.
It's the standard that all the world's banks, stock exchanges, and payment systems are moving to. It allows for much richer, more structured data within transactions.
So if XRP and Cardano are compliant with this standard, it means they speak the language of global finance.
You got it. It signals to a huge bank or a financial institution that these assets are built to fit into their existing rigorous frameworks. It removes a huge barrier to entry. It makes them look less like a volatile tech asset and more like a piece of next-generation financial infrastructure.
That's a powerful narrative. And it seems like there's even growing institutional anticipation for some, let's say, less conventional assets, too.
Indeed. The sources point to some big expectations for Dogecoin. There's analysis suggesting a bullish reversal could be coming, and a lot of that is tied to the potential launch of a grayscale DOGE ETF.
An exchange-traded fund for Dogecoin, that would open it up to a whole new class of investors.
A massive new class. An ETF is a regulated, easy-to-buy product. It would signal a belief that there's enough capital interest and regulatory comfort to package DOGE for the mainstream. It just opens the floodgates.
And even Shiba Inu got a mention in the source material.
It did, yeah. Top traders are apparently pointing to signs of a potential breakout and recovery for ESH after its recent weakness. The signal suggests that after a period of consolidation, momentum might be returning.
So if we pull this all together for you, the listener, it seems like there are two really powerful stories happening at once.
I think that's right. First, you have the market volatility doing a really important positive job. It's clearing out all that excessive speculative leverage and creating a much stronger base.
And second,
While the prices were bouncing around, the really critical fundamental growth things like the IMF mentioning XRP or assets getting aligned with that ISO 2022 standard that just keeps moving forward completely uninterrupted.
so what this means is that those scary drops we talked about,
Yeah.
50% declines in some alts, the dip in Bitcoin, they're seen by analysts not as a sign of weakness, but as the price the market pays to stabilize itself. It's the market growing up.
It's shedding risk and building real utility at the exact same time.
Which brings us to the final question for you. Given that these structural indicators are pointing toward a healthier market, one that's been cleansed of leverage, how much weight should you put on that underlying utility that's being built, like XRP for cross-border payments, versus just focusing on the day-to-day price charts? What to you stands out as the most compelling positive signal for the long run? That's something to think about.